Hello and welcome to Soundbites, Fidelity's monthly podcast where we talk about all things investments. My name is Lucas DePaulbay and I'm from Fidelity International, and I'm pleased to be joined this month by Fidelity's Global Head of Macro and Strategic Asset Allocation, Salman Ahmed. Salman has over 25 years of investing experience, holds a PhD and Master of Philosophy in Economics and Finance from Cambridge. His role at Fidelity sees him and his team oversee our broader global macroeconomic inputs that feed into our various investment teams, as well as our strategic asset allocation process. We're excited to have someone of Salman's caliber on the show. Welcome, Salman.
Thank you. Thank you for having me.
And before we get into the nitty-gritty, and today's discussion, not surprisingly, is really going to be focused on the big event everyone's talking about, and that is the US election. But before we get into that, I'm always interested in the people that I speak to. And one of the things I know you're very passionate about is cricket. And from what I understand, Australia's playing Pakistan tomorrow in Sydney, I believe. So tell us about your passion for cricket.
No, definitely. I mean, to be fair with you, I have a lot of respect for the Australia team. I wish my team could learn a thing or two from the Aussies. But yeah, I mean, but Pakistan is Pakistan, so I don't know if you followed the series against England. We beat them for you guys, so you can then go into Ashes with a different perspective. But yeah, it's still every team's dream to beat Australia in Australia, and I hope it will happen in my lifetime.
Yeah, well, we'll see what happens, and yeah, good luck to both teams, I guess. But let's kick off the podcast because, if we sort of start off with things, and it's been an interesting couple of days. There's been a lot of speculation, who's going to win. The pollsters were saying it's going to be a very tight race. Now, it's actually ended up being a resounding win for the Republicans, winning the popular vote, the Senate, and I believe they've also won the House as well. So pretty much full control and a pretty broad mandate in terms of their policy agenda. And I guess in terms of the policy agenda, what are some of the key things that you believe we should be watching and observing in terms of policy, particularly from a macroeconomic perspective?
Sure, no, definitely. I think, as you mentioned, Lucas, I think the final results are that President Trump is outperformed the polls by 2-3 percentage points across the board. So that's a challenge for the polling industry. I think they are getting it, or his nature of his support, wrong now consistently. But that's for the polling industry to sort out. But the betting markets, to be fair with you, for most period over the last few weeks have been around plus 60% plus, and then they had this volatility going to the elections. But, on general, the tilt had been towards a potential Trump victory. But also, I think one of the scenarios which was probably underpriced was the red sweep. So, which is that, if President Trump wins, it was very likely as well that he would carry with him the down ballots. That said, obviously, the Senate election was much more comfortable, but the House came very, very close, and it's likely the majority in the House of Republicans may be smaller than last time around. So there are some nuances there. But the reality is that we are looking towards a red sweep, which is quite different from a divided government when it comes to fiscal policy. So there are two, I think, components of macroeconomic policy we are focused on and have been focused on for many months now. We've done a lot of work on, what happens if tariffs are put in as they are being discussed. We've also done the work on fiscal deficits impact and then growth impact as a result of the policies which were being discussed, on the campaign trail. So all in all, the tariffs rate which I talked about is 60% in China, 10 to 20% on the rest of the world, depending on which speech you pick up. But these are significant numbers. And on fiscal policy, given that we have a red sweep, that means tax cuts can happen, the extension of TCJA can happen. There is no talk of fiscal pragmatism in any of the campaigns, both campaigns, Democrat or Republicans. But in a red sweep scenario, fiscal deficit in the US can go above 8%, which is very significant, obviously, compared to pre-pandemic period, but also very abnormal when you look at years outside of recessions.
So if we think about the tariffs, because that has been a point that has been discussed extensively, it's sort of interesting because if you think about the first Trump presidency, we obviously saw some tariffs coming in. Over the Biden presidency, it's fair to say that that policy has been continued somewhat. So with the policy, and Trump has been very vocal around putting tariffs on things, If that was to occur, and I guess we went to that maximum position that Trump's been talking about on tariffs, those higher tariffs, what are then the possible implications for the broader economy? Because we know over the last couple of years we've been battling inflation. Central banks have been obviously trying to get a handle of that. What do higher tariffs, if we do see them, mean for that aspect of the economy?
Sure. So our assessment is that if tariffs are done as they are, being discussed, although there is a discussion to have whether how will tariffs be put in place. I think that's an important discussion to have as well. But let's assume that to your question, Lucas, that tariffs are done 60% on China and 10% on the rest of the world. So
Uh-huh.
our assessment is that gives one-off shock to core inflation of 300 basis points. So
Right.
U.S. core inflation shock is up to 300 basis points.
Uh-huh.
Now that's a one-off shock, but that can become a sustained shock depending on how it shocks inflation expectations. Are tariffs impermanent? Are they a part of negotiation, or broader negotiation strategy? And then how does the Fed react to it? Which is also important because of potential deterioration in the relationship between a Trump presidency and administration and Fed, will have consequences
Uh-huh.
both on inflation expectations and potential real rates as well. So it's a significant change. And just to give you perspective, China tariff rates pre 2017, 2018 were around 1.5%, 2%.
Uh-huh.
They went to 10%. But now we're talking about bringing 10 to 60. So
Uh-huh. Uh-huh.
this is not about tariffs. It's also about the rate, which is
Yeah.
being discussed. And these are significant rates. So as I said, I think we see 300 basis point as an upper ceiling estimate. And
Uh-huh.
then we think about, okay, what are then the scenarios, how they're going to get placed? Are they going to be done incrementally? Are
Uh-huh.
they permanent? Are they, are they part of a, as I said, broader negotiation strategy? Then the shock is, can transmit itself
Uh-huh.
differently to a, one of big
Uh-huh.
300 basis point shock.
Uh-huh. And if you think about, I guess you mentioned China, and we saw China undertake a pretty significant stimulus in September.
Yeah.
The initial market reaction was positive. However, some of that excitement around that stimulus has fizzled out. Now, the market has been really sort of waiting now and saying, well, what's fiscal stimulus going to look like in China? Do you think that the changes in the US government, the possibility of high tariffs on China, do you think that is going to have any implication as to China's next move in terms of things like fiscal stimulus?
I mean, it may impact the timing. To be fair with you, even without tariffs, China needs a stimulus.
Mm-hmm, mm-hmm,
And we saw the pivot in September start to take place. And it came on the back of a run of weak data, especially
mm-hmm,
credit data. So credit demand has been missing in China. And that is the, very broad-based worrying sign, linked with the lack of domestic demand. And then that plays into employment. So I think, yes, there are implications. So we have the NPC tomorrow, which
mm-hmm,
I think will give us more detail and discussion. But please remember that China will need stimulus for many quarters ahead. This is not a
mm-hmm,
one-off quarter thing. I think they will have to think about how they calibrate the numbers, how they manage expectations, because the economy will need support for many quarters to come as this balance sheet issue gets resolved. A stopgap stimulus is what worries the market, and rightly so. And that's, that can undo the progress quite quickly if it's stopgap. So the tariff risks complicate the picture, but I don't think they are the primary driver. They are basically,
mm-hmm.
they, amplify the need for a thought out fiscal rather
Yeah,
than, triggering a fiscal, if you see the
yeah.
point.
No, absolutely. And if we think about outside of China, and I know from an Australian perspective, there's been a lot of early discussion around what does it all mean for Australia in terms of from a trade perspective. Any views from yourself around more broadly beyond China? You know, many governments will be reassessing what it means, how do they deal with this new presidency and the different policies. What are the possible implications beyond China in terms of trade, this sort of potentially more protectionist type of attitude? What does that mean?
Sure. So I think obviously in Asia Pacific part of the world, obviously the focus is on China, as you rightly pointed out, Lucas. But I think it's also Europe. Europe is not
Mm,
Europe
yeah,
is the second. In fact, I would say more exposed to all this than
yeah,
China,
right.
because Europe, like China, is an open economy. They are export focused as well. Both of them have current account surpluses with the US. Now, rightly and wrongly, Trump administration or Trump overall thinking is that current account deficits are bad. You can argue the mechanics of that argument, but Europe is the other one. And another angle where Europe gets exposed is geopolitics. So you have two conflicts as well running: Ukraine, Russia, and then obviously in the Middle East as well. On Ukraine, Russia, some of the views of Trump campaign have been very much more clearer than they have been on the Middle East conflict, which is more complicated and complex as well, given you have multiple stakeholders involved. So I think there is a security angle there, obviously the tariff angle from the economic policy perspective, and then the more medium-term structural angle that the idea that the first Trump presidency was one-off has been destroyed, right? So is it start of a more structural trend of protectionism? It has to be also be thought out, because the responses will be different, right? If you think these issues are here to stay, and as you mentioned earlier, Biden administration put when it came in 2020, did not undo the tariffs. They maintained them, right? So that also gives a signal value that whatever changes happen may have staying power.
Yeah, absolutely. And then from a market perspective, it's interesting because obviously a lot of the focus has been on the, what are the possible implications of the macroeconomics and so forth. But if you think about the markets, just after the elections, we saw the US market rally quite hard. If we look at previous elections, that tends to be a common early phenomenon where I guess markets like clarity, they like certainty. I mean, this time around, it was pretty clear cut. The result came through pretty quickly. But further afield, how do you think, from a market perspective, this presidency will impact markets, if at all?
Sure. So I think we have to look at the rates market very, very carefully, because I think they will be very sensitive to any fiscal deployment, the nature of it, the size of it. I think it will take months and months before it gets, you get the clarity, because the new administration doesn't get into the White House, and the new Congress is not sworn in till Jan of 2025. So we'll have to go with the expectations, and the immediate next step is who's going to be in cabinet, Treasury Secretary, the key appointments. I think they are going to be, they're going to take a lot of focus. And I think the pressure on rates is likely to be on the upside. Dollar does well, I think, in this environment because of tariff risks. And again, you can argue the form and shape of the tariffs, and we'll have a lot to say about it, I think, going forward. But dollars does seem to be the clearest barometer of that trend. And then equities are interesting in the sense they rally no matter what. So they have been in that phase, because there have been other multiple things happening as well beyond presidential elections, as you know very well. So I think there we have to be thought about the sectoral implications, which sectors may benefit from deregulation. We have seen financials do very well, and I think that trend can continue. Rate sensitive sectors may come under pressure on a relative basis. But overall, you are looking at, nominal GDP upswing here, right? And I think if you look beyond the first stage of it, the second stage is, how the Fed reacts to a nominal growth going to 7%, right?
Yeah.
Growth going from already US growth was around 3% real growth, right? It can easily go to 4%. And then inflation can go back above 3. So you're talking about 7% plus nominal growth. So the question is, can the Fed cut when nominal growth is running at 7%? Do we have to think about hikes again? Maybe a bit early to think about it. But, those are the stage 2 questions in 2025. And then equities may not like it. But, right now we are in stage 1, which is reflation, or what I call Trumpflation, which is basically policy-driven reflation. This is not a natural cyclical phenomenon. This is potentially using the policy to pull everything up and also do some transfer of growth through tariffs, right? You basically transfer growth back to the US from Europe and China.
Fantastic. And if we think about the broader macroeconomic environment, and one of the things that I know you and your team look at quite closely is looking at what does the future environment maybe look like. And you do have a couple of scenarios that you look at. And one of those that has been quite prominent is this concept of a soft landing scenario. And that has been, I guess, Fidelity's most probable scenario for the last little while. How do you think if you think about that scenario, what are the risks to that soft landing scenario potentially going forward with this new presidency coming in?
So I think the clear risk is upside risk. I think during summer we were, playing with the recession soft landing,
Mm-hmm.
spectrum, and we held on to our soft landing view, mainly on the flow of the data, on consumption patterns we were seeing. Labor market was slowing, but it was not falling
Mm-hmm.
off the cliff. Obviously, there was a lot of reaction on the basis of non-farm payrolls, monthly
Mm-hmm.
non-farm payrolls release, but they tend to be very volatile and
Mm-hmm.
subject to revisions. So, you are basically forecasting a data with errors, and you don't know about these errors till like 6 months or a year
Mm-hmm.
later. And
Mm-hmm.
these errors are significant. So, the last benchmark revisions were up to million jobs.
Mm-hmm.
But the Fed has been focused on it because they said, oh, we are data dependent, but you are dependent on quality data. So we were looking at a holistic range of labor market data, and it gave us the signal that there is it's slowing, but it's not falling off the cliff.
Mm-hmm.
And in level terms, it's still a very strong labor market in level
Mm-hmm.
terms. So we stuck to our soft landing view as it was tested during summer. But now, as we are moving towards 2025, obviously we have to think about the impact of these economic policies.
Mm-hmm.
We'll have to make a judgment on at least what the base case would look like. But here, I think
Mm-hmm.
it's pretty clear the direction of travel is, as I mentioned, nominal GDP upswing, which means that you have to think about Trumpflation scenario, which
Mm-hmm.
is mixture of reflation, and the critical question of how the Fed responds to that once as it starts to get bedded in. It's too early for them to comment on it or
Mm-hmm.
think about it, but obviously a fiscal policy stimulus which takes your deficit from 6 to 8 is a very significant one. And tariff rates, as I mentioned, are not incremental increases, right?
Mm-hmm.
So I think we are basically, as we are thinking about 25, we will be punching up probabilities of what looks like reflation, what
Mm-hmm.
has policy centricity around it. And I think, to my mind, a recession in the US now happens if the Fed responds to all this.
Right. Yeah.
Right. So it's a different sequence now
Mm-hmm.
compared to,
Mm-hmm.
I think, if we had a Harris administration, for example.
Mm-hmm. And maybe on a final point, I guess, there's a lot of moving parts. Obviously, there's geopolitics, there's change in presidencies, there's things that have been impacting markets for some time, such as, inflation. Where are you the most optimistic? If you think about the next 12 months over the next, 2025, what areas are you the most optimistic about?
So I think the areas I like are equity markets still, I think,
Mm-hmm.
can because they are not only nominal asset classes, they are also real asset classes in some
Mm-hmm.
ways. So I think obviously there will be sectoral implications on what we are discussing, and we can go into the more details of that. So as I said, financials, defense stocks, can benefit. And then you have obviously, but you have to then navigate this with geopolitics, retaliation, risks, and at some point a Fed,
Mm-hmm.
which becomes more aggressive. So that's the navigation pathway, but it's going to be more volatile. I know volatility has been very low going to this election,
Mm-hmm.
which makes sense, right? People don't want to take a view. The polls were suggesting a very close race, so so you could see, like, at the market level, realized vol has been coming down. So
Mm-hmm.
bond market volatility is back. I think that will remain the case because we're going to have a lot of expectation based moves right now till
Mm-hmm.
till the
Mm-hmm.
administration comes in and starts putting things into play, into motion. I think that rate volatility affecting equity volatility has to be watched as well. So overall, we are still risk on with a different lens on it,
Mm-hmm.
compared to a couple of months ago.
Well, Salman, thank you very much for your insights. Very timely and certainly great to sort of explore the various possible scenarios. But I think, one of the interesting things is that markets seem to be continue chugging along. So we'll see what happens. And all the best for the cricket as well. So we'll see what
Thank you
happens
very much.
there the
Thank
next
you very
day or
much.
so.
At least please give us one game, please.
Thank
So
you
my
very
brother
much,
is
Salman.
Australian, so I've been telling him that when England comes in, we need to have a proper banter.
Absolutely. Absolutely.
Perfect. Thank you very much, Lucas.
Thank you for joining us in this month's podcast. If you'd like to subscribe, please reference your favoured podcast platform. Or if you'd like to provide us feedback, please email us at podcastaustralia@fil.com.
This podcast is issued by Phil Responsible Entity Australia Limited, AFSL number 409340. This podcast is intended as general information only and has been prepared without taking into account any person's objectives, financial situation or needs. Please note that past performance is not a reliable indicator of future performance. You should consider the product disclosure statement and target market determinations for Fidelity Australia products available at fidelity.com.au.